Most day traders fail because they skip the fundamentals. If you don't understand the key components of day trading or how to use them correctly, that's probably why you're losing money or struggling to make consistent profits. I will be pouring all the knowledge about day trading that I've gained over the past decade of my own trading career into one video. And since I'm doing that for absolutely free, it would be awesome if you could just smash that like button for me to help out with the YouTube algorithm. If you are new, go ahead and click that subscribe button because we come out with content like this each and every week. Let's start off with basic strategies that are super simple and easy to learn. These foundational strategies are crucial for beginner traders because they give you a proven framework to work with instead of making random trades based on gut feeling. Once we cover the basics, we'll dive into advice from some of the best traders in the world, and then we'll tackle the psychology side of trading because let's be honest, that's where most traders actually lose. Swing trading is a style of trading where you hold a stock for a very short time, usually just a few days, to capture small moves in its price. It's like catching waves. Stock prices often swing up and down rather than moving straight up or down. Swing trading sits between day trading and long-term investing. You hold a stock for a few days or a week, rather than selling it the same day or holding for months. The goal is to buy low, sell high on those short swings, grabbing a quick profit from the next small rise in the price. In practice, a simple swing trading plan might look like this. Pick a stock that's been moving steadily. For example, you notice one has been rising gently each day. Wait for a small dip. Be patient until the price drops a bit. A short pullback. Buy during the dip. Purchase the stock at this slightly lower price, expecting the trend to continue. Hold for a few days, often 2 to 5 days. Keep the stock while it bounces back up. Swing trades are short-term, so you won't hold it for weeks. Sell on the bounce. Once the price climbs higher again, sell the stock and lock in your profit. Put simply, you're looking to buy on a little dip and then sell a few days later on the bounce. Imagine a stock that had been climbing toward $160, but then dips a bit to $126 over a couple of days. You think this dip is temporary and buy the stock at $146. A few days later, the stock bounces back up to around $280 and even a bit higher. You then sell your shares around $280, making about $134 profit on each share in just a couple days. This quick buy low, sell high cycle, lasting just a few days, is a classic short-term swing trade. In essence, swing trading is simply waiting for a tiny pullback, a dip in a rising price, and then getting out after a quick bounce. Over just a few days, you capture that small gain before the stock starts moving again. Scalp trading, or scalping, is basically making a bunch of very quick trades to grab tiny gains from small price swings. Scalpers do many trades each day, often minutes or seconds long, aiming for just a few cents of profit on each one. The idea is that catching lots of little moves can add up to a decent profit if you manage your risk. This is everything a scalp trader looks for. Quick trades on short charts. Scalpers watch very short time frame charts, like 1 minute or 5 minute charts, and focus on immediate price moves. As soon as they see a stock tick up or down by a few cents, they may buy or short with the plan to exit moments later. Speed and precision are important. High liquidity assets. Scalpers pick very liquid stocks or assets, big, heavily traded companies or markets, so their orders fill almost instantly. High liquidity and tight bid-ask spreads mean a scalper can buy and sell without large price slippage. For example, they often trade blue chip or penny stocks, forex pairs, or popular ETFs where many buyers and sellers are active. Scalping depends on repetition. A scalper might do dozens or even hundreds of these mini trades every day. Each trade only makes a tiny profit, but by repeating the process over and over, the small wins quickly add up. In the end, consistent small gains from many trades can total a large profit for the day. Let's look at a live example. The stock on screen is moving between $344 and $350. A scalper might buy 1,000 shares at $345.5 as seen right here and, within seconds or minutes in this case, sell them at $348.70, making a $3,000 profit on that trade. Then they look for another small move to trade. Even though each profit is relatively small, doing dozens of trades like this in one day can add up. For instance, making $50 10 times is $500 by the end of the session. Trend trading is all about catching a stock's longer-term move. You buy when a stock is clearly going up and plan to sell when that uptrend ends. Or you sell when a stock is clearly headed down. In other words, a trend trader follows the price. The trend is your friend. If the stock has been climbing day after day, you ride that wave. If it's been sliding, you wait or go the opposite direction. It works by first spotting a trend on the chart. Maybe the stock has been making higher peaks each day. In an uptrend, you'd buy on a small pullback and hold through the climb. In a downtrend, you might short sell. You keep an eye on the chart. As long as it keeps making higher highs, uptrend, or lower lows, downtrend, you stay with the trade. Once the pattern breaks, for example, an uptrend stock stops making new highs and starts dipping, you exit to protect your profit. Simple tools like looking at price swings or a moving average line can help identify the trend. For example, platinum futures have been rising from around $850 to $1,000 over a week, consistently making new highs. You notice this and buy some futures when it dips to $946, aiming to sell at a new high like $974. You hold as platinum keeps climbing. If it later stops rising and drops below its recent lows, you would sell to lock in gains, thinking the uptrend is over. Breakout trading means jumping in when a stock finally breaks through a key price barrier. Imagine a stock is stuck under $100 for days. That $100 is a resistance line. If it suddenly jumps above $100, that's a breakout. Breakout traders enter right as the stock breaks past resistance, or below support, betting that it will start a bigger move in that direction. It's like seeing a crowd surge through an open door. You sprint in to catch the next big wave. How it works is you first mark the stock's important levels. Maybe it hit $100 and fell back a few times, so that's a resistance ceiling. When the price closes above $100 with higher than usual volume, you take that as the signal. On a breakout up, you buy. On a breakout down, breaking below support, you sell or short. You set a stop loss just on the other side of the broken level. For example, if you buy at $100, you might stop out at $99 to cap losses if it fails. If the breakout holds, the stock often accelerates into a new trend. The key is entering quickly after the break and having a plan to exit if it turns back. So an easy example is Exness. It had been bouncing this resistance line since the pre-market. It also touched this line at the market open. This pattern is called a descending wedge, and it's a popular pattern for breakout trading. The goal is to buy as soon as the price breaks this resistance line and breaks out. In this case, it does. And here is where you would place your order. This strategy can be paired with scalping or swing trading. Gap trading is about trading those sudden overnight jumps or drops in a stock's price. A gap happens when a stock closes at one price and then opens the next day at a significantly different price, skipping any trading in between. For example, it might close at $50 yesterday and open at $55 today. That $5 skip is a gap. Gap traders look at these jumps and try to trade on them, often expecting the price will keep moving or will come back to fill the gap. This is how it works. Gaps usually happen because of news or events after the market closes, like an earnings report or big announcement. At the next open, if the stock gaps up, opens higher, some traders will buy immediately expecting the momentum to continue. Others might do the opposite. If they think the gap up is too much, they might bet on the stock falling back toward yesterday's price. This is called fading the gap. There are two common plays: riding the gap, buying on a gap up, or selling on a gap down, hoping the move continues, or fading the gap, betting it returns to the old level. Either way, gaps are volatile, so traders use quick stop losses, since gaps can reverse quickly. Here's an example. Exness stock closed at $3 the day before. Overnight, great news comes out, and it opened at around $5 today, a 2-point or $2 gap up. A gap trader could buy at $3, thinking the good news will push it even higher. Alternatively, if they feel $5 is an overreaction, they could short the stock at $5, betting it will drop back toward $3. If the stock continues climbing to $8, which in this case it did, the gap trader profits. If it falls back to $3, the gap trader losses. Momentum trading is a strategy where you buy stocks that are already moving strongly in one direction, either up or down, and aim to profit by riding that trend for a short period. The idea is that stocks showing strong recent performance are likely to continue moving in the same direction. It's like jumping on a train that's already moving and hoping it keeps going the same way. How it works: find a hot stock. First, look for a stock that's already making a big move. Maybe it's hitting new highs or climbing quickly with big volume. That's a clue that traders are paying attention. Join the move. If the stock is moving up, you buy. If it's dropping fast and you're comfortable shorting, you can short sell. You're joining the trend, not trying to guess the top or bottom. Use a stop loss. Place a stop loss just below a recent low, if going long, or above a recent high, If shorting, this protects you if the move suddenly reverses. Watch for signs to exit. When the move starts slowing down, like volume dropping or the stock stalling, you get out and take your profit. So we are looking at Zenitech again. It climbed around 30% already this morning, breaking its previous high. A momentum trader might buy at $5.50 as it breaks out, betting the rapid rise will continue through the day. They hold as long as the stock keeps making new highs. If it slows down, say it stalls at $6.50 or dips back to $5.50, the trader will sell to lock in profit. The goal is to ride that big move. If the stock keeps shooting up to $7 or $8, the momentum trader wins big, but if it suddenly drops, they cut losses quickly. This strategy can also be paired with swing trading, gap trading, scalp trading, and breakout trading. Most traders miss out on consistent profits because they overlook the 3 critical signals from the MACD indicator that should be analyzed before every trade you make. In this video, I will show you the exact MACD system I use to avoid false breakouts and capture front-side momentum. It also made me over $30,000 on a single trade last year. And oh yeah, this works whether you trade stocks, forex, crypto, futures, whatever. But first, you need to understand how moving averages work. Moving averages track the average price of an asset over a specific period, smoothing out short-term volatility to reveal the underlying trend. The key lies in their speed. Shorter-term averages react quickly to price changes, while longer-term ones lag but provide broader context. For example, the 9 EMA, exponential moving average, is highly responsive, clinging tightly to recent price action like a surfer riding a wave. The 20 EMA follows behind, acting as a middle ground. It filters out minor fluctuations but still reflects the near-term momentum. Finally, the 200 EMA crawls slowly, representing the big picture trend over months. When the market rallies, the faster 9 EMA surges upward first, followed by the 20 EMA, and eventually the lumbering 200 EMA. This creates what you call a bullish stack. All 3 averages aligned in ascending order: 9, then 20, then 200. A visual confirmation that buyers are in control across all time frames. This alignment doesn't only signal momentum, but consensus among traders, which makes it one of the most reliable indicators of a strong, sustainable uptrend. Now that you understand how moving averages work, let's break down the key components of the MACD. When you look at the MACD indicator, you'll see the MACD line. This is calculated by subtracting the 26-period EMA from the 12-period EMA. This is like your momentum speedometer. Then you would notice the signal line, a 9-period EMA of the MACD line. When MACD crosses above it, that's bullish, and if it's below, then that means it's bearish. Lastly, we have the histogram. These bars show the distance between the MACD and signal lines. Taller bars mean stronger momentum to either side. But the part where most traders go wrong is they mess up the settings of the MACD. This is a huge part of it because if you don't set this up correctly, then your signals will be way off and your technical analysis will be totally wrong. Think of it like reading a map with coordinates. If you create your own coordinate system, you'll end up in a different location than everyone else. In trading, that means buying when others are selling, which is a terrible mistake. So here are the MACD settings that I used: 12, 26, and 9. Feel free to pause and screenshot. These settings allow me to trade the front side of the move and avoid those pesky false breakouts. Let me walk you through how I applied the MACD in real time on this high-volume stock, which checked all my usual criteria for a morning trade.
Nice.
At the open, the signal line hovered above the MACD line. That is a bearish signal, as mentioned earlier. Even though I was eyeing a long position, this crossover warned me to hold off and wait for confirmation. Then came this halt. When trading resumed, the signal line remained above the MACD line, but the gap between them had gotten much smaller. This convergence signaled weakening downward momentum and hinted at a potential bullish reversal. That was my cue. I entered long right as the MACD line began its ascent above the signal line, marking the official bullish crossover. As you can see, a powerful breakout followed. The MACD line stayed firmly above the signal line throughout the surge, validating the uptrend. But here's where it gets critical. Midway through this push to the upside, the MACD line started curving toward the signal line. This divergence shows weakness. It should tell you that the momentum is fading and the trend is ready to reverse. I exited my position here, locking in gains just before the pullback. The MACD isn't just about entries, it's about timing exits with precision. Understanding convergence and divergence separates reactive traders from strategic ones. Here's a second example. You need to first make sure the stock you're trading meets the criteria before you even think about looking at the MACD. This one did. Just before the open, the MACD line was below the signal line. But then I noticed the volume increased as we got closer to the open, and the MACD line started getting really close to the signal line again. What does that mean? Exactly, it's a bullish signal. So I placed my order and the chart moved up really fast. But look at the MACD line. It basically spiked past the signal line. Sometimes it happens fast, so you have to move quickly. Then when the momentum was fading, the MACD line started getting closer to the signal line. Then came this massive dump. The MACD is really good at these signals. Those were two really good trades using the MACD. I want you to understand this. So here's a great explanation from one of the best traders out there.
Beginner traders who don't yet use the MACD are going to be more susceptible to falling into the traps of false breakouts. So this is, again, let's see, SGBX. This is a chart, 1 minute chart of a stock that I traded just yesterday. I actually made $5,000 on it. This was a pretty nice move. And it began right here at 9 a.m. with breaking news that came out. Okay, so we have breaking news that comes out top of the hour. And so initially, I see the stock on my scanners. I pull it up on the 1 minute chart. And of course, I pull up the level 2. Now, when I first take a trade on something like this, I'm not really looking at the MACD in those first few minutes, because the thing is, this is a stock that has been going basically sideways and then suddenly has news that comes out. So I know that the moving averages are going to be spiking up. That's what they're always going to look like when you have breaking news. So what's happening with these indicators? They are diverging, right? They're diverging. That's because the price is moving quickly. And so what's happening with the MACD? This blue line is moving way above the signal line. This is our signal line. And it'll continue to move up until the price begins to sort of stall out. So right here, the price started to stall out. The price rolled over a little bit. We came down to the support of the 9 moving average, but what began happening was our moving averages began to converge. They began to come back together. And that was especially noticeable right here when the price broke down. Because when the price broke down right there, that dragged the 9 moving average back down, that dragged the MACD back down, and right here we have a MACD crossover. We have the cross where the fast line here, the actual moving average convergence divergence line, moves against the signal line coming back down. This for me is a critical indicator. When I see this crossover, I am no longer a buyer. As a beginner trader, you will find more accuracy if you're only trading when the MACD is open. So as a beginner, it's best to focus on setups that have the highest probability of success. So let's watch what happens right here. MACD is against the trade right here. So nothing in here, you should be trading. No trade, no trade, no trade. And then right here, we can get back in. This, as soon as I see this, and as soon as I see it curling here, I know what's happening. I know this is getting ready to cross over. Sometimes putting it right in front of you makes it hard to miss, right? If it's down here, sometimes you might just stop kind of looking at it. So I'll do this occasionally. And I really encourage this for beginner traders. Okay, so we're going sideways here. And then what happens as we come into the open? We get the crossover. Do you see this crossover right here? Boom, we cross over. So we cross back over and we cross over with strength. And look at this move that we end up getting. So we end up getting a squeeze on this all the way up here. And we stay open. The MACD stays open, it stays open, and we push higher and higher. So we come up all the way to this level up here, about 620. We start to pull back, and then here we go. That's another crossover. Imagine focusing on trading this only in this area here and only in this area here. How do you think you would have done? Probably pretty well. Trading it in this area here, it was sideways. This is not going to pay you. We don't make money buying at 5 and selling at 5, or buying at 380 and selling at 380. We want to buy at 4 and sell at $5, and we would love to do that inside of 5 minutes.
Check the link in the pinned comment for a 30-day free trial to TradingView, the absolute best charting platform in the game. But here are some things to keep in mind about the MACD indicator. If you decide to trade using the MACD, resist the urge to pair it with any other strategies. This could leave you more confused than ever and cause you to lose money. Use the MACD and pair it with a simple entry strategy. Now, this may sound counterintuitive, but don't rely only on the MACD. A lot of traders do this and it messes up their win rates. Heavy reliance on the MACD will actually end up hurting your profitability. So keep doing all your other due diligence, like making sure the stock or commodity you're trading has good volume, a good setup, and waiting till you have the right entries. Also, you need to remember when you add the MACD to your chart to use the right settings that I showed you earlier in the video. Professional traders aren't trying to double their account each month. They're building sustainable processes that work across different market conditions. I made $15,000 in 12 minutes using 2 simple lines on my chart. I used a scalping setup that has worked for me over 300 times last year, and I'm about to show you exactly how it works. Look, I get it. You've probably watched dozens of trading videos where someone promises you the holy grail of day trading, only to leave you more confused than when you started. But here's the thing. What I'm about to show you isn't complicated. It's not some mysterious strategy that only works in perfect conditions. It's 2 indicators, 1 simple rule, and the discipline to stick to it. Let me introduce you to what I call the golden alignment setup. It's built around 2 indicators that most traders use wrong, but when you use them together the right way, magic happens. We're talking about the MACD and the VWAP. Now, before you roll your eyes and think,
"Oh great, another MACD strategy?"
hear me out. The MACD on its own is decent. It shows momentum, but momentum without context is like having a fast car on a road with no signs. You might be going fast, but you have no idea if you're heading in the right direction. That's where the VWAP comes in. The volume-weighted average price isn't just another moving average. It's literally showing you where the big money players are positioning themselves. When institutions are buying, the price tends to stay above VWAP. When they're selling, it tends to stay below. It's like having a window into what the smart money is doing.
Nice.
But here's where most people mess this up. They try to use these indicators in isolation. They see MACD cross over and they jump in. Or they see price bounce off VWAP and they think it's time to trade. That's not how you get consistent results. The golden alignment happens when both indicators are telling you the same story. When MACD is positive, meaning the MACD line is above the signal line, it's telling you momentum is bullish. When price is above VWAP and it's sloping upward, it's telling you the big money is supporting higher prices. When these 2 things happen together, that's when the magic happens. Let me show you exactly how this plays out. I'm going to pull up some recent examples from my trading, and I want you to see how clean these setups actually are when you know what to look for. When you open up TradingView, link down below, go to the Indicators tab and enable MACD and Volume-Weighted Average Price. All right, here's my first chart. First thing I'm looking at is the VWAP. Right here. Price is above at the open, which tells me that my first signal is good. Then I check the MACD. Right now, the signal line is above the MACD line, showing momentum. If I were to take this trade, I'd wait for a micro pullback, then look to place my order right around here, aiming to catch the move while keeping risk tight.
Tight, yeah!
Quick PSA. It's only during the edit that I noticed this stupid fucking mistake. The MACD is positive when the MACD line is above the signal line, not the other way around. I kept saying it the other way around, so excuse me for that. All right, let's move on to the next example. Okay, looking at this chart, I start with the VWAP right here. Price is sitting above for a minute, then moves below it, which gives me a sign to wait. So then I glance at the MACD. It's also giving me a sign to wait because the signal line is not clearly above the MACD line, suggesting there's a bit of indecision. So I ended up waiting at the start, then things got a lot clearer. Both the MACD and the VWAP are positive now. So for my entry, I'd be interested around here to stay aligned with the trend while keeping my risk in check. Here's another example. Once again, my eyes go straight to the VWAP. Price is above it, so I'm thinking bullish. Then I confirm with the MACD, which is clearly positive, and tells me momentum is picking up. Again, I'd wait for a micro pullback, which, when I looked at the 10-second chart, happened right around here. Then I'd place my order near this level to take advantage of the setup without stretching my risk. On to the next chart. Now, for this setup, the first thing I notice is the VWAP. Price is below it, which is leaning more bearish for me. I don't completely write off a chart if the price is below the VWAP. When momentum is strong, price action can change really quick, so in this case, I'll choose to wait. But I also need to check the MACD, and it's positive, pointing to strength in the move. But does that mean I take this trade? No, it doesn't. Both of them need to agree first, and as we see,
it never happens.
Scalping can look simple when you watch someone else do it, but the truth is there's a fine line between quick profits and quick losses. The difference is knowing exactly what to look for and acting on it without hesitation. I've got a short clip from Warrior Trading that breaks down some of the most practical scalping tips you'll ever hear. Watch closely, because even one idea from this could change the way you trade your next setup.
Sometimes people who are adopting a scalping strategy think that they should trade all day long. They should take 100 trades in a day, just scalp, 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 scalp. Okay, that is one way to do it, and there certainly are some traders who do that. But what I'm a big advocate of is quality over quantity. So focusing on the best quality setups. And that means you're looking for a setup that gives you a 2-to-1 profit to loss ratio. So you're looking at the trade and you're saying, on this setup, I'm gonna risk $100 to make potentially 200. You take the trade, and even if you take your profit off really quickly as a scalp trade, and you only make $100 on it, that's okay. The setup had the potential for more. The problem is that a lot of scalp traders, they end up lowering their quality standard in order to just take more trades each day. And they're taking trades that at best only offer a 1-to-1 ratio. And when they only get, $50 instead of the 100, when they end up incurring the losses, which of course will happen, they find themselves with a negative profit to loss ratio. And this can be extremely frustrating because a scalper might take 20 trades and have only 3 losses, but those 3 losses are so big, it wiped out the profit from the other 17. That is, you feel so defeated, demoralized, you feel like the worst when that happens, right? So many of you know it, I know it because I was there too. When I first adopted a scalping strategy, when I was getting started, I had a negative profit loss ratio of 2-to-1. My average losers were twice the size of my average winners. And that meant I would have needed to be trading at 66% just to break even. Well, I wasn't trading at 66% because I was still learning the strategy. That's too high of a bar. And so what I essentially did was I set myself up for failure without even realizing it. Scalping is difficult, but trading is difficult too. And there's a lot of things that make a scalping strategy a great strategy for beginners. Instant resolution, reduced exposure time, and just simply the fact that it's easier to predict what a stock is going to do over the next 5 minutes than over the next 2 hours or 3 or 4 days, certainly. In order to improve your accuracy, what I always encourage traders to do is focus on the quality of the setup. Look for high quality setups. And yes, you're leaving money on the table by scalping that setup instead of holding for it to potentially realize, the entire move. But you know as well as I do that if you don't take your profit off the table, it can disappear. And that's why so many scalp traders adopt that strategy, because they've had enough times where they took a trade and they were up a lot, they didn't take anything off the table, and boom, it goes not just back to break even, it ends up turning into a loser. That's the worst. So focusing on quality is number one. When you focus on quality, what that in turn does is it improves your accuracy. When your accuracy improves, you're not having as many losers in total. And most likely, you're eliminating some of those losers that became the outliers that were really big. So now what happens is accuracy improves, profit loss ratio follows, and then consistency follows. And you know what that breeds? Confidence.
But here's the secret sauce that makes this setup work consistently. It's not just about the entry. It's about knowing when not to take the trade. This is what separates the winners from the losers in scalping. If MACD is positive but VWAP is sloping down, I don't trade. If price is above VWAP but MACD is still negative, I don't trade. Both have to be aligned. Both have to be telling me the same story. This simple filter eliminates about 80% of the setups I used to take. And guess what? Those were the losing trades. The other crucial element is risk management. With scalping, you can't afford to let winners turn into losers. My rule is simple. If I'm up 50 cents per share or more and the stock starts to lose momentum, I'm out. I don't care if it might go higher. I take my profit and wait for the next setup. This golden alignment setup has completely changed my trading. I went from being all over the place with my entries to having a clear, repeatable process. MACD positive plus VWAP positive equals trade consideration. If both aren't aligned, I don't trade. It's that simple. The beauty of this approach is that it works on any time frame and any stock, currency pair, or crypto. I use it on 1-minute charts for quick scalps. But I've seen traders use the same logic on 15-minute and even hourly charts for swing trades. The principles remain the same. Follow the momentum and follow the money. Remember, consistency in trading comes from having a plan and sticking to it. This setup gives you that plan. It removes the guesswork and the emotion from your trading decisions. When both indicators are aligned, you have a green light. When they're not, you wait. Most importantly, this isn't about being right all the time. It's about being profitable over time. Some trades will lose money, and that's just part of it. But when you're only taking high-probability setups and managing your risk properly, the winners will more than make up for the losers. The morning star is a 3-candle bullish reversal pattern that appears at the end of downtrends. Despite its popularity, traders frequently misuse this pattern. Some common mistakes are entering too early. Many traders enter positions immediately after the second star candle without waiting for confirmation from the third candle. The pattern requires the third candle to close above the midpoint of the first candle's body to confirm the reversal. Ignoring volume. Trading the pattern without volume confirmation significantly reduces its reliability. The third candle should show increased volume to strengthen the reversal signal. Wrong market context. Using morning star patterns in sideways or consolidating markets instead of defined downtrends reduces effectiveness. The pattern works best when it appears at the end of a clear downtrend. Poor stop-loss placement. Setting stop-loss orders too close to the second candle's low makes positions vulnerable to normal market volatility. Stops should be placed below the low of the second candle or third candle if it's lower. Trading in isolation. Relying solely on the morning star without other technical indicators or market context analysis leads to false signals. The solution would be to only trade morning star patterns that check all your boxes. You want to wait for the third candle to close above the first candle's midpoint on rising volume. Make sure it shows up after a clear downtrend, not in choppy moves. Also, set your stop just below the lowest low of the second or third candle, and always back it up with at least one other indicator. The bullish engulfing pattern consists of a small bearish candle followed by a larger bullish candle that completely engulfs the previous candle's body. The common mistakes include trading without context. Using the pattern in isolation without additional confirmation is problematic. Bullish engulfing patterns only succeed approximately 55 to 63% of the time. Ignoring market trend. Trading bullish engulfing patterns in strong downtrends often results in weak, short-lived reversals. The pattern works better as pullbacks in uptrends or at significant support levels. Premature entries. Entering immediately after the engulfing candle closes without waiting for confirmation, such as price breaking above the candle's high, leads to frequent false signals. Lack of proper confluence. Overlooking key factors like support and resistance levels, trend lines, RSI or MACD signals, moving averages, and volume reduces signal validity. And poor risk management. Failing to set appropriate stop-loss orders below the engulfing candle's low or not defining risk-reward targets leads to inconsistent results. To fix this, always treat a bullish engulfing as just one clue, not a sure thing. Only trade it in an overall uptrend or at a strong support zone. Wait for the next candle to clear the engulfing high before jumping in, and look for backup from things like trend lines, moving averages, etc. as mentioned before. Then lock in your risk by placing a stop just below the engulfing low and aim for clear profit targets. This way, you blend context, confirmation, confluence, and proper risk management into every setup.
Nice.
The Harami pattern is a 2-candle reversal formation that consists of a large candle followed by a smaller candle that fits entirely within the body of the first candle, suggesting potential trend exhaustion and reversal. The name Harami means pregnant in Japanese, referring to how the smaller candle appears inside the larger one. This pattern shows that momentum from the first candle has slowed, with the market becoming indecisive. These are the common mistakes you should avoid. Ignoring market context. Trading Harami patterns without considering the overall trend reduces effectiveness. The pattern works best as a bullish reversal in downtrends or a bearish reversal in uptrends. No confirmation. Entering trades based solely on the Harami's appearance without waiting for additional confirmation, such as a candle close beyond the pattern's high-low, leads to false signals. Volume and structure neglect. Ignoring volume analysis and not examining the size of the second baby candle. Small inner candles often indicate weak reversal potential. Risk management is also important on this one. Inadequate stop-loss placement and ignoring position sizing rules undermines trading discipline. Premature entries. Acting immediately without waiting for follow-up confirmation reduces success rates. Here's what you can do to solve this. Only trade it in the right trend. This means to buy in downtrends. Sell in uptrends, but you should wait for the next candle to close beyond the pattern's high or low before entering. Also remember to check that the volume backs up the move and that the baby candle isn't too tiny. And always define your risk by sizing your position properly and placing your stop just beyond the outer candle. Pin bars, also known as Pinocchio bars, are reversal patterns that feature long wicks or tails extending at least 2/3 of the entire candle's length, with small bodies positioned near one end of the candle. The long wick shows that price moved significantly in one direction during the session but was rejected, with buyers or sellers stepping in to push price back, creating a potential reversal signal. Remember to avoid these mistakes. I've seen a lot of traders make them. Pattern misidentification. Not every long wick candle qualifies as a pin bar. The tail must be at least 2/3 of the entire candle, with a small body near one end. Entering immediately after the pin bar formation often results in poor timing. Wait for confirmation, such as a close beyond the tail or follow-through candle. Also, using pin bars against the dominant trend is unreliable. These patterns often act as continuation signals rather than reversals. Trading pin bars that appear randomly in price action rather than at key support resistance levels, trend lines, or Fibonacci levels reduces effectiveness. Low volume timing. Pin bars forming during low volume periods or after sharp moves are often just profit-taking signals, not genuine reversals. Let's see how it should appear on a chart. You should only trade ones with at least 2/3 of the candle as a tail and a small body tucked at one end, and only when they pop up at major support, resistance, trend lines, or Fibonacci zones in the direction of the main trend. Wait for the next candle to close past the tail or show clear follow-through before pulling the trigger, and avoid pin bars born in low-volume lulls or right after sharp moves, since those are often just profit-taking, not true reversals. Hammer patterns appear at the end of downtrends and signal potential bullish reversals. They have small bodies positioned near the top of the candle, little to no upper shadow, and long lower wicks that extend at least twice the length of the body. As seen above, the long lower wick shows that sellers pushed the price lower during the session, but buyers stepped in and drove the price back up, closing near the high. Look out for these common errors if you trade the hammer. The first one is mistaking any lower wick candle for a hammer. True hammers have specific proportions: small body near the top, minimal upper shadow, and lower wick at least twice the body length. But entering immediately upon hammer appearance without waiting for the next candle to close above the hammer's high frequently results in losing trades. Don't use hammers outside of downtrends. That reduces their reliability. Hammers signal potential reversals within existing downtrends. Using the wrong timeframes. Using hammers on very short timeframes, for example, the 1 to 15-minute chart increases noise and false signals. Higher timeframes provide more reliable signals. Let's watch the hammer in action. You want to only trade true hammers on higher time frames in a clear downtrend and ideally at a support zone. Wait for the next candle to close above the hammer's high before entering. Look for backing from volume or indicators like RSI or moving averages, and always place your stop just below the hammer's low with a defined risk-reward target. This ensures proper pattern ID, trend context, confirmation, confluence, and risk management all in one setup. Shooting stars appear after uptrends and signal potential bearish reversals. They have small bodies positioned near the bottom of the candle, long upper shadows that extend at least twice the length of the body, and little to no lower wicks. The long upper shadow shows that buyers pushed the price higher during the session, but sellers stepped in and drove the price back down, closing near the low. The mistakes I see most often are entering immediately after seeing the pattern without waiting for bearish follow-through. Confirmation requires a subsequent candle closing below the shooting star's low. This pattern only works reliably at the end of sustained uptrends. It's less meaningful in sideways or range-bound markets. Low volume on the shooting star day weakens the bearish reversal signal. Look for volume surges and confluence with resistance levels. When trading, only trade shooting stars that follow a clear uptrend and form at major resistance. Make sure the candle has a long upper wick with a small body at the bottom, and wait for the very next candle to close below its low before entering. Double-check that volume picked up on the shooting star day and you're on a daily or weekly chart, not a noisy intraday time frame. And always place your stop just above the high with a defined risk-reward target. Remember, these candlestick patterns fail not because they're inherently flawed, but because traders misuse them. You need to screenshot or write down these key takeaways. This trendline technique is the fastest and easiest way I think I've ever used to make money while trading. And the framework that I use gets insane results for traders, expert or beginner. So now I'm going to break down every step for you so you can just copy it. First off, what is a trend line? Put simply, A trend line is a straight line drawn on a price chart that connects two or more price points, typically significant highs or lows, to indicate the general direction of the chart. It helps traders visualize trends and identify potential support and resistance levels. So it's only right that the strategy I'm about to show you revolves around the trend line. You never want to complicate it with indicators or whatever else. I only use support and resistance as secondary confirmation to strengthen my trading decisions. Now I'm going to show you an example of this when going long. So as you can see, the chart touches the line multiple times, at least 3 times. It shows that it's in a downtrend. I like this because if it reveres, it's going to be strong. Look what happens when the price breaks this trend line. This is where I place my order, and as you can see, it's a winning trade. I don't set a fixed take profit. Instead, I ride the trend until the price breaks the trend line, which signals that the trend has ended. This could go on for hours in this case, or minutes, it really just depends. That's why you want to keep your take profit flexible. Let's take a look at another example. As we see again, the price touches the line at least 3 times, 4 in this case, so it's clear the stock is in an uptrend. I wait for the trend to be broken like it was right here. Then place an order and wait to see what the price does. Very simple, straightforward. Now let's flip the script and take a look at a short position. Here, the price touches the trend line at least 5 times. So it's very obvious the chart is in an uptrend. You wait for the price to break this trend, then what do? Exactly, that's when you determine your entry. So, as you can see, if you've been following along so far, your entry short would look something like this. Do you set a determined stop loss? That's right. You don't. In this case, the short went on for about 2 weeks, which was awesome. So this strategy is all about the trend line, which determines both my entries and exits. The aim is to capture most of the price move by staying in as long as the trend holds. And you only exit when the trend shows signs of reversing. If you try this method, remember that it relies on clear, consistent chart patterns. If the trend line holds, you stay in the trade. If it breaks, you exit. I want you to understand this. So here's a great explanation from one of the best trendline traders out there.
In the first example, we'll cover a trendline breakout trade. Here you can see an uptrend as indicated by the higher highs and higher lows. At one point, it started to go sideways while also making lower highs. We can connect these highs to create our trend line. Now keep in mind that the prior trend was bullish, and price moving sideways for a long time, we can expect an impulse move in the direction of the trend. So wait for price to break out of the trend line with an impulsive move. Then wait for price to break once again past this high to paint a new higher high. This confirms the bullish momentum, and you can enter on the newly created fair value gap and retest of that high. But what about fake breaks? Here we have 2 obvious points of swing highs that we can connect with each other. As the price action develops, we can see it approach the trend line with a 3rd touch. Now it looks like price is breaking out of the trend line with 2 up candles, closing above the trend. Some of you might be thinking that this is a valid breakout, but you always have to keep the other side of the trade in mind. Because if you look closely, this move up wasn't actually that energetic or explosive. If we look to the left, we can see this down move with candles double the size of the current move up. We also have equal highs right here, which is an area of liquidity. So with this in mind, you want to wait for price to develop more and show you more information. Be demanding. Here we can see that it did go down from these highs with a bearish engulfing candlestick. As price continues down, it breaks the swing low. This confirms that it is a bearish trend. Now we can enter when a new level is created, such as a fair value gap. Enter at the retracement with your stop above the high and target the levels lower. Finally, we'll go over an example of trend continuation with trend lines. Here we can see price coming from a downtrend. At one point, it started to change course and move higher. Then it came back down and filled the inefficiency before retreating back. This gives us 2 anchor points where we can connect a trend line. Now all we have to do is wait for price to return and touch the trendline area. As price approaches the trend line, we can see that it went slightly below the trend. However, it did not have momentum behind it, or energy, which is what you want to look for a true breakout. So as we wait for price action, we can begin to see a bullish engulfing candlestick paint. You can enter long here or wait for more confirmation. As the market moves up, it has created a new higher high. This gives you extra confirmation that it's bullish. So now you could enter here on the retest of this resistance area, which has now turned into our new support level. Stop losses set below and target the levels higher. We have only one more example, and you don't want to miss this because trend lines can be areas of liquidity. In this example, we can see the market is in an uptrend, as indicated by the higher highs and higher lows. If we know that the market is bullish, you want to wait for it to reach an area of support before entering along. In this case, we can see a fair value gap just below these lows. We want to wait for the market to take out liquidity down first before reaching these highs, which we can identify as trendline liquidity. Trendline traders will have this trend line to act as resistance. This area will likely have liquidity resting, as the traders who are short have their stop losses set just above this trend line. Since we know that the overall trend is bullish, the probabilities of a trend continuation are much higher. So we'll wait for the market to retrace and enter once it reaches the fair value gap. Stop losses set below the fair value gap and take profits set at the levels higher.
Check the link in the pinned comment for a 30-day free trial to TradingView, the absolute best charting platform in the game. And here are some advanced tips you need to keep in mind. As price moves, your trend lines will be crossed, so it's important to continuously adjust them using new points to reflect the current market, whether that means drawing steeper lines or shifting to new highs or lows. You should always use top-down analysis by incorporating multiple timeframes. Start with a higher time frame to understand the overall trend, then narrow it down to the time frame you plan to trade. Finally, use support and resistance areas as take-profit zones. This helps if you're not holding trades long-term or if you're aiming for quicker, gradual gains. Very simple. But why are good entries so important? Picture this. You're at a busy market eyeing a popular fruit stand that sells mangoes. Let's say you love mangoes, and you notice the vendor restocking with fresh, ripe mangoes, and a small crowd gathers around her stall. You spot the opportunity and decide to buy a few mangoes before the crowd gets any larger, and you pick the best fruits. By acting promptly, you secure the juiciest mangoes at a fair price. Later on, as more shoppers swarm the stand, the remaining mangoes are either overripe, overpriced, or both. This scenario shows the importance of your entries when day trading. Entering a stock at the right moment will not only enhance your potential for profit, but it can give you the best risk to reward and make it less likely that your stop loss gets hit. On the other hand, mistiming your entry may result in buying at a peak, which messes up your profitability, leading to more losses. Therefore, just as in the busy market, being attentive and making timely decisions in day trading is crucial for the best outcomes. At the end of this video, you will possess an entry strategy that will not only increase your probability if you're already profitable, but it can help you newer traders get on the path to profitability even faster. Now let's look at a live example of a trade I took recently. There are a few ways I use to get the perfect entry, but I'm going to show you two different ways. So with this strategy, I'm looking for a good price based on pre-market support and resistance. One thing to keep in mind is you never want to place a buy or sell order in what I call no man's land. This is the worst mistake you can make. Your entry should always fall either at whole dollars, half dollars, support, or resistance, key breakouts, or key breakdowns. So in this case, my entry was based on this resistance line that I drew from pre-market. I noticed that just before market open, these candles were struggling to break past this level. To be able to catch a trade like this, you have to be quick and observant. Plus, your stock selection is very important for these entries to be good. There was a lot of volume just before the market opened, so I knew this would be a quick scalp right out of the gates. When all these conditions came into play, I placed my entry order long, right above the resistance price. Not below, not on, and not way above. Just a few cents above. This was on the 5-minute chart. So if you're quick and notice all the signals, you can get an entry and exit like this. Let's see what ends up happening. It's a winning scalp trade. It reversed quickly after. That's why the right entry is important. Any later and you would have been caught in this dump and lost money. Let's look at another example. Here, this stock didn't really do anything pre-market. It consolidated, but there was good volume. I've noticed these entries work best on stocks with at least 3 million in volume, so that was a great sign. As the market opened, the volume even increased, which was an even better sign. Because the stock gapped up on the day, it was the leading gapper that morning. Look what happened at market open. It pulled back, which was the final sign. Then I placed my order right above the open, just a few cents above, like 2 or 3 cents. Then look at the move it gave, which was awesome. Remember, don't place your order below or on the open price. You want it just a bit above. This is for a little added confirmation. You also can't hesitate when jumping into trades like this because, as you can see, it moves pretty quickly. This entry strategy works well with mid and large cap stocks. But look what happened later on. We got this beautiful wedge pattern. The volume was already good on the stock at this point. It was about 12 million shares. And the volume in this area was increasing. So I placed another long order right a few cents above the break of this wedge. Then look what happens. It gave an amazing move to the upside. In both cases, if my entries weren't in the right place, I would have either had a losing trade or I wouldn't have capitalized on the entire move. So that proves this strategy can increase your profitability. I want you to understand this. So here's a great explanation from one of the best traders out there.
Added there at $15, now looking for $15.50. So there's $15.24 on the ask, $15.29, $15.78, nice. Taking a little profit, was looking for $15.50, pretty much got that. Holding 600 shares now. High of that candle, $15.75, new order $15.75. We're up 83%. So that entry that I just took at $15 was a micro pullback right there. That's a micro pullback. You can see it on the chart. So right now there isn't a setup. Right now it needs to pull back again in order for us to see another setup form. So like I'll take that trade right there for the break of 16 because for me, I can justify the risk on it. So now watching over $15.95, new order at $16 a share, and then looking for a squeeze up to $16.50. Watching this dip here, added on the dip at $15.50. So trying to buy the dip and now looking for the curl back up to 16. So this now we're looking for the first 1 minute candle to make a new high and the break through 16. So when I see 15.85 print, I'm going to add for the break of 16. So added right there, there's $16. Nice. And I'm taking a little profit as it breaks that level. So now this is again added at 16.20. This is a micro pullback. There's 16.38 and I take a little profit as it breaks through that level. Dip for me at 15.94. I'm going to try to do some dips on this. I want to see if it curls back up in a sort of fierce way, if we get a really nice bounce. So I do a starter when I'm doing this kind of dip, and then I look to add to it, and I can either add a little lower or a little higher. So in this case, I'm taking the profit because that was a decent little trade, puts me up over 10,000. Didn't give me a chance to add lower, and it popped up about 20 cents, which is enough to take profit.
Check the link in the pinned comment for a 30-day free trial to TradingView, the absolute best charting platform in the game. So now that you have a good understanding of the strategies, now we'll dive into some advice from one of the best traders out there. Then we'll break down the psychology needed to become profitable. By the way, any links mentioned would be in the description and the pinned comment.
I want you to learn how to capitalize on FOMO without falling victim to it. So what does that mean? There are times in the market where there's a lot of FOMO, where traders are getting really amped up, they're getting really excited, and stocks are going crazy. This is a time to capitalize on that volatility by being more aggressive. Falling victim to it means getting emotionally fueled, getting frustrated, and starting to get stubborn. Just chasing, buying something at high of day without really calculating your risk. Gamblers think only about profit. Traders are thinking about risk. But when you're looking at a trade, what I always say is that a trade should have the potential to double whatever you're risking. But that means at the beginning of the trade, you have to determine how much you're willing to risk. When it comes to trading, let's just say you put the full $500 into a position. You could say, I'm risking 500, but that's not really true because you're only risking 500 if you're going to hold until it goes to zero, which would be a terrible thing to do because it would mean that when it was down 20%, 30%, 40%, you just decide to keep holding, even though obviously you were totally wrong on the trade. So what if we set a stop, let's say, of more like $50? So I'm going to put a $500 position into this, but if it goes down and I'm down $50, I'll sell and I'll take the loss. So my focus has always been trading at the open and trading in the morning. I find that the first 1 to 2 day trades, usually 4 out of 5 days, I can hit my goal in the first 30 minutes with 1 to 2 trades. I keep it simple. I try to hit my daily goal and then ease up, right? We know how quick it is to lose money, so once we have some money in our pocket, we want to hold on to that. How do we find a stock that's going to make a move and get in with a low risk entry? And that's the name of the game, finding low risk entries. Every time we trade, we know we're exposing ourselves to risk. So how do we minimize that risk? That's what we call finding a good setup. Any good setup is an opportunity for us to get into a trade with as little risk as possible. So a good setup means we might be risking $100, but we have the potential to make $300. Inevitably, when we get on a losing streak, it's going to start to impair our judgment. So being able to be in touch with your own emotions and maintain composure, even through a losing streak, is really, really critical. Okay, so skill and discipline, these are like muscles. They require exercise to grow. And it's not something that once you grow them, you have them forever and you don't have to work on them anymore. You still have to exercise them, right? And that's what I experience every day. I'm still exercising my ability to have self-control, to have discipline, right? Now, the skill is something that I've built up. So you can't take away the skill to ride a bicycle, and you can't take away the skill to identify good stock charts, right? Those are skills. But the discipline is something that we always have to work on. And what I have found is that once a stock is already up 10%, it is becoming an outlier for the entire stock market for that day. It is pretty rare for a stock to go up 30, 40%. In fact, on any given day, usually there's only 3 or 4 that will do that. But you know what? I've been trading for a long time, and every single day, there are a handful of stocks, 3, 4, 5, some days a couple more, some days a couple less, that are making a big move. Because every day there are stocks that have news. So I look for the stock, number one, to have news. That's what's going to bring in the volume. That's going to create the 5 times relative volume. That's what's going to make the stock already up 10% on the day. And I have found for small account traders, which is going to be most of us, trading stocks between $1 and $20 is going to be better because our goal is to make 10% per day. So it's going to be easier to get that on a $2 stock. A $2 stock only has to go up 20 cents and you're up 10%. Sometimes people who are adopting a scalping strategy think that they should trade all day long. They should take 100 trades in a day, just scalp, 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 scalp. Okay, that is one way to do it, and there certainly are some traders who do that. But what I'm a big advocate of is quality over quantity. So focusing on the best quality setups. And that means you're looking for a setup that gives you a 2-to-1 profit to loss ratio. So you're looking at the trade and you're saying, on this setup, I'm going to risk $100 to make potentially 200. You take the trade, and even if you take your profit off really quickly as a scalp trade and you only make $100 on it, that's okay. The setup had the potential for more. The problem is that a lot of scalp traders, they end up lowering their quality standard in order to just take more trades each day. And they're taking trades that at best only offer a 1-to-1 ratio. And when they only get, $50 instead of the 100, when they end up incurring the losses, which of course will happen, they find themselves with a negative profit to loss ratio.
I'm not going to lie to you. If you're not willing to keep learning, you will not make it far in trading. This may not be what you were expecting to hear, because traders online always say,
Just copy my strategy and become profitable in no time.
or
Just use my one simple strategy and it will make you tons of money.
this is utter bullshit. As a trader, you constantly need to keep learning. It's like being a doctor or engineer. They spend years and years mastering their craft. So with trading, it's not about learning one pattern and that's it. You need to spend time sifting through your trading data and metrics to refine your skills. If this scares you and you don't want to have an unfair advantage in the market, stop watching, because the other truths I'm about to share with you will do just that. The second truth goes like this. You have to be willing to go further than most other traders. What do I mean by that? Basically, when most people get into trading, they underestimate how hard it will be to actually make money, and they just end up quitting. I've been in this game for almost 9 years now, and I guarantee these hard times will come. Either you're in a losing streak, the market is really slow, or you could be dealing with something that's troubling you mentally. All of this could mess up your trading focus, and it's where others just decide to quit. But what they don't realize is that when you stick through these trials and learn from them, as I talked about in the first truth, it actually makes you more profitable and increases your skill level. To avoid falling into this trap of wanting to just quit, you need to have a long-term mindset. Give yourself time to learn and to get better. Successful traders always have a long-term mindset because they fully understand it's not about getting rich quick. The third truth is that you can't be afraid of drawdown. But what is a drawdown? When it comes to day trading, losses are inevitable. So, to put it simply, imagine you started a trading account with $20,000 and you were able to turn that into $30,000. That's now the equity high. If you have a losing trade or a losing streak and your account is now at $25,000, you are in a drawdown. Not every trade is going to increase your equity high. Most of the time, you will be trading in a drawdown. Two super important ways to combat this are to have a high win rate strategy and not allow trading in a drawdown to get you frustrated, because then that will only lead to more losses and make things worse. But this next truth is something I see traders not only struggle to understand, but also it causes them to fail even before they've started. But you don't have to worry. I have a solution to this problem that's helped literally thousands of traders. What you need to understand is that when it comes to trading, it takes money to make money. I constantly see videos online where gurus lie to you and say you can start trading with less than $500, when in reality, this is impossible. To make money and test strategies, you need money. The more you have to start, the better. But that's way easier said than done, obviously. So the solution to this issue is to use a prop firm. Simple. A prop will allow you to start with the appropriate amount of capital. In this way, you're not putting added pressure on yourself to make money with a small account. I'll leave a link in the pinned comment to 2 of the best prop firms in the world. No, I'm not just trying to sell you something. I'm genuinely trying to help you. This next truth helped me realize what I needed to do 5 years ago, which put me on a path to profitability, and it's defining your trading edge. What is a trading edge? An edge is your strategy that is tried and true, a strategy that you understand to a T, one that works in most, if not all, markets. Not only that, but having an edge also includes knowing how to best execute this strategy. If you don't have a clear understanding of your edge, you will 100% lose money. This is where most traders fail, and how you can get ahead of 95% of traders. I always say, if you can't write your strategy step for step on a piece of paper, you don't have an edge. Practice in a demo and refine this edge. See when it works best, see what makes it fail, and understand the win rate. This is how you refine your edge. But if you don't have one, you have to start working on it immediately. It means the difference between you failing and joining the top 5% of traders. If you're still watching this late into the video, I can already tell that you have what it takes. And I'm not just saying that. Here's a bonus tip for staying. You need to be more reactive and less proactive. Let me explain what that means. When you load into your setup every morning, look at the market for what it is, not what you want it to be. In that way, you are more reactive. You should always trade according to the market and not what you want. Always trade the market you're in, not the market you want to be in. If you follow these truths correctly, it will make you more profitable. Thanks for watching. Check out this video next.